website so that you can watch this later. Joining us today to discuss the pre-feasibility study is George Salamis, President and CEO of Integra, Andre Saint-Germain, Chief Financial Officer, Tim Arnold, Chief Operating Officer, Mike Spiker, Engineering Manager, Mark Stockton, VP of Sustainability, and myself, Josh Surface. The company has planned a brief presentation on the pre-feasibility study, which was released yesterday, February 9th, and then we'll open up the webinar for questions. Please note your microphones have been muted and we've turned off our videos for bandwidth reasons. If you'd like to ask a question, please use the Q&A feature on your Zoom panel. You can ask the question and then we will do our best to get to all of them. Panelists today will be making forward-looking statements. Please refer to the news release and the company website as well as our presentation for all the cautionary notes and disclosure. We'll also show them to you on the screen here momentarily. With that, I'd like to hand it over to George Salamis, President and CEO, who will take you through the beginning of the presentation.
Okay, thanks, Josh. Thanks everybody for joining us this morning. So following on from our highly successful 2019 PA study, we're really excited to be rolling out Integra's very first pre-feasibility study for the Delamar project situated in southwestern Idaho. In short, just to kind of summarize, when in operation, Delamar will be a very large producer of gold and specifically one of the largest silver producers in the US. And so that's a key element in this study. Among the other various attributes highlighted in this PFS, one of the key thematics here is the optionality factor, and it's optionality in inflationary times. The market is constantly expecting inflation, as we've seen in other studies, and it didn't get a lot of that this time around. So we're presenting a phased development approach with 2 stages, which we believe provides maximum operational flexibility with low-cost heap leaching, for example, in stage 1, and project expansion via mill construction in stage 2. So it's really 2 projects in one. Stage 2 to be paid out of cash flow from stage 1. So really kind of to summarize that point, picture a project where you don't need to build a great big mill, a big expensive mill straight out of the gate to start generating cash flow from gold and silver production. And picture that all of that in a tier 1 jurisdiction such as Idaho. So these are really rare elements in the mining world today, and that's what Delamar is all about. It's really full of optionality from development and operating perspective, initial cash flows to be used for to increase production profiles and longevity of the mining operation, full stop. Another aspect of the study, the project PFS, is showing really robust annual gold equivalent production. And so specifically with respect to that profile, 163,000 ounces of gold equivalent for the first 8 years, and an annual average production profile of 110,000 ounces of gold equivalent for the entire 16-year mine life. So just to summarize there, a really robust production profile and a long mine life supported by a really large reserve base, which is what we've demonstrated in the study. The pre-production CapEx is low. The project will cost $282 million to build. We regard this as a low amount of capital required to build on a large production profile in the US, again, a tier 1 jurisdiction for mining investment, a real plus. I think the market was expecting much more capital than what we put on the table in the study. This time around on the study, relative to the PA, the PFS is highly leveraged to silver, a really important factor. And a lot of that is largely due to the mill construction paid for by the heap leach. As I mentioned earlier, Delamar could potentially become one of the largest silver producers in the US at its peak of production. And so on that note, we believe that there's the prospect of premium valuation to come from the silver component, producing far more silver than we did in the PEA study. 35% of our forecasted revenue will come from silver, and that's an important factor, obviously out of myriad of perspectives, not the least of which, we're going to be generating a lot of silver to fuel the greening of the US economy. In addition, there are several exciting upside scenarios that were not included into this PFS study. Some of them are potentially game-changing. Kind of the 2 that float to the top is the game-changing enhancements to come from gold and silver recoveries using the Albion process. And additionally, further enhancements to come from the potential to add high-grade silver mineralization from Florida Mountain to future production scenarios. Neither of those two factors were input into the study, but we're working on those for the future, and they're tremendous upside cases, both obviously subject to further studies. The new PFS study on Delamar really demonstrates a lot of sustainability-driven economics with some of the practices that we built into the study. A lot of attention was paid to sustainable practices in the study, ones that also enhance project returns as well. And we'll talk about that a bit later on in this webinar. But all the development scenarios shown in the PFS study contemplate the use of technologies, new technologies designed to minimize environmental footprints and, in fact, increase profitability. So an important factor. And last but not least, the benefits to the state of Idaho and the US are substantial. When you look at it, the Delamar PFS is showing a project that at its peak will employ more than 300 people at the mine site. Obviously, there'll be significant benefits to the state from a tax revenue basis. In fact, we believe that when the mine is up and running, we'll be in the top 25% of corporate contributors in terms of tax in the state of Idaho. So really important for the state. And in addition, the project will produce a very meaningful amount of silver, which I mentioned earlier, which is both a currency in demand, but it's also a commodity that has a real role to play in the electrification of the US. So kind of moving on to the specifics. So specifically sort of focusing on the project itself now. The phased approach that we've outlined in this PFS allows the company to really stage the development, starting with a low-cost, robust heap leach project in year 1 and increase production in stage 2 through construction of a mill in years 2 and 3. This phased approach reduces risk and really provides the maximum flexibility to the prevailing economic environment in connection with the decision to pursue stage 2 at the time. That's a key point. A few highlights in the study. The heap leach and mill PFS after-tax NPV5 is $412 million with a 27% after-tax IRR using $1,700 gold and $2,150 silver. If you look at the same scenario using spot prices, it's obviously much higher than that, and refer to our press release yesterday for those numbers. The pre-production capital expenditures of $282 million include contingency of 20% on things like processing facilities, heap leach, tailings, etc. And so the average annual production derived from that is 163,000 ounces of gold equivalent for the first 8 per year for the first 8 years of mine life. And the average for the entire 16-year mine life is in fact 110,000 ounces of gold equivalent over that time period. As I mentioned, 35% of all revenue will be driven by silver, making Delamar one of the largest domestic US silver producers when at its peak, and really providing a lot of material to drive green technologies. In terms of the other aspects that we've added to the studies, as mentioned, we've always tried to approach mining differently, and this study utilizes green technologies that really aim at decreasing carbon footprints while increasing profitability. And we'll hear more about these a bit later on in this webinar, but those include railway and on-site power provision using solar arrays, LNG plants for electrical needs, which will be discussed later, as I mentioned. So that was all a big mouthful. I'm going to pass things on to Tim and Mike to dive into the specifics of the PFS and project development and operating parameters. So Tim and Mike, over to you.
Thanks, George. So the Delamar projects will be an economic driver for Owyhee County, which is in southwest Idaho. And it's going to employ more than 300 people at its peak, as well as a significant number of contractors and consultants during the construction phases. Company expects to finance the mining equipment for the operation. Primary fleet consists of 2 23 cubic meter hydraulic shovels, 1,636-ton haul trucks, 5 production drills, and ancillary support equipment. In addition, the railway system will provide the majority of ore hauling from pit to processing, replacing approximately 5 haul trucks. Project contemplates a 35,000 ton per day heap leach process. This is a 30% throughput increase from the 2019 PEA. The heap leach will process oxide and mixed ore from both Florida Mountain and Delamar deposits. In year 1, company can choose to commence the stage 2 and begin construction of the 6,000 ton per day mill. This is a 3 times size increase contemplated from the PEA. It will be grinding down to 150 micron, which is slightly finer than the 212 microns that was in the PEA via a sag and ball mill. Process flow sheets for both of the heap leach and milling circuits have been designed around historical test work from the 2019 PEA and metallurgical studies completed in 2020 and 2021. I'm going to get a little bit more detail from Mike here on the heap leach and mill processes.
Thanks, Tim, and good morning, everyone. So the Delamar and Florida Mountain deposits vary significantly in the metallurgical aspect, but despite those differences, the most economic processing of each requires essentially the same flow sheets. On the heap leach side, crushing will be done in 3 stages. We'll start with a primary gyratory crusher. That'll feed a secondary crusher and open circuit via a heap leach coarse ore stockpile with 3 reclaim feeders. And then we're rounding out the crushing circuit is 2 cones in the tertiary position, crushing to a nominal feed size of a P80, 12.7 millimeters. This primary crusher is sized to handle both the heap leach and the mill throughputs. So the addition of a second primary crusher for the mill circuit will not be needed. Ore placement will primarily be done using overland conveyors, grasshoppers, and a radial stacker. An agglomeration drum will be added to the process for year 2 production when Delamar ores are introduced, as we anticipate about 45% of the heap leach feed from Delamar will require agglomeration. There's 3 phases of the pad construction here. You can see on the left-hand side is phase 1, and that's Jacob's Ridge. Then the following phases are in the valley fill on the right. Each of these phases will have their own preg solution collection and pumping, and their own event storage as well. Recovery of gold and silver from pregnant solution will be done via a Lcoe circuit up near the crushing area. On the mill side, crushed ore from the non-oxide coarse ore stockpile will be delivered via 2 reclaim feeders to a 6.7 meter by 4.6 meter 2985 kW sag mill, and that'll have pebble recycle. Following the sag is a 4.6 meter by 9.1 meter 2985 kW ball mill. It'll be in closed circuit with cyclones, producing a 150 micron P80 product for the rougher flotation feed. Rougher concentrate will be reground to 20 micron via a 1120 kW isomill. The concentrate from that will be leached in 6 agitated tanks. Flow between them will be by gravity, and we have a target resident time of 24 hours. Bleach slurry then reports to a tank and cyclone style CCD circuit. The pregnant solution will be sent over to the heap leach Lcoe plant. Non-cyanide contacted float tailing will be stored in a separate facility out at Slaughterhouse Gulch. After detox, the concentrate leach tail will be blended with a approximately 1-to-1 ratio of coarser float feed or float tailing, to help the settling of that fine material. And that facility will be upstream of the heap leach facility and fully lined for cyanide code mandates, and will be buttressed by the heap leach facility. Additional info on all of the completed metallurgical testing for this PFS can be found in the news release. And thank you.
Okay.
I will turn it over to Andre.
Thanks, Mike. So as you can see on this CapEx table, if you look at the column on the left side, the total mining, processing, and infrastructure pre-production CapEx came in at $282 million. We are quite pleased, given the inflationary environment, that the project pre-production CapEx came in below $300 million, and that's including 20% contingency on the processing facilities, the heap leach, and the tailings. And that's also assuming financing of the mobile mining equipment. Add to that a working capital and cash required for reclamation bonding is estimated at about 26 million. If you look at the column in the middle right there, that's our expansion capital and our sustaining capital. As you can see, the bulk of it is the construction of the mill and the tailings, which is expected to occur in year 2 and year 3. And really, like George mentioned earlier today, the flexibility in our phased approach allows us to decide in year 1 if we want to proceed with stage 2 or not. So the expansion capital related to the mill and the tailings, which will be spent in year 2 and 3, is estimated at 160 million. And it is expected that this could be financed through internal cash flow. And then we'll look at the cost here. So we do, perfect, thank you, Josh. So in terms of a mining cost, we estimated 189 per ton mined, which equates to $6.08 per ton processed. With respect to processing cost, the 599 here is basically blended heap leach cost and milling costs. The heap leach costs are 374 per ton heap leach, and the mill processing cost 1257 per ton milled, for combined processing costs of 599 per ton. And our G&A costs are estimated at 86 cents per ton, for total site operating cost of 1292 per ton processed. So these operating costs basically results in, if we look at it on a cash cost basis, cash costs including royalty of 923 per ounce. If we look at it on the co-product, which is the column to your right, the bottom table, so 923 on a co-product basis, and site level all-in sustaining cost of 955 per ounce on a co-product basis. And we'll just show you what the 2021 global all-in sustaining cost curve look like. And you can see that Delamar, with our cost of 955 per ounce, takes us in the lowest quartile of the curve. Perfect, and that's it for me, and I'll pass it on to Mark to highlight our sustainability-driven initiatives.
Thanks, Andre. So the PFS has incorporated multiple sustainably driven initiatives to lower the project's greenhouse gas emissions, fossil fuel needs, and overall environmental footprint. Our team has worked closely with sustainability consultants from the outset of the PFS process, evaluating opportunities for us to reduce our impact and increase our economics. Two prominent technologies we'd like to highlight are, firstly, Railveyor. So Railveyor is a light rail ore haulage system that replaces roughly 5 diesel haul trucks. Ancillary benefits of Railveyor include less diesel consumption and the associated emissions, as well as it creates less dust, so it decreases the amount of water used for dust mitigation. And lastly, it also creates less noise. Railveyor runs on electricity and actually generates energy on downhill hauls, such as on the long downhill haul between Florida Mountain and the mill site. Railveyor is used in multiple mines around the world, most notably at Agnico's Goldex in Val d'Or, northern Quebec, and at the Doe Run mine in Missouri. The second item we'd like to highlight is the solar Lng microgrid that will supply the mine power. This system will require significantly less CapEx compared to a line upgrade from the local grid utility. As well, the greenhouse gas emissions from this energy mix will be an estimated 13% lower than the current local utility grid mix. The microgrid levelized cost of energy, LCOE, and this is an important parameter used when you're comparing energy systems. So our proposed electrical mix is actually 63% lower than the local electric utility. Together, between Railveyor and the solar LNG power plant, we save 145,000 tons of CO2 emissions, And that equates to taking approximately 32,000 passenger vehicles off the road for a year. And in a dollar amount, these two technologies save us roughly $83 million in energy costs over the life of mine. So both sustainable and economic. So now I'm going to pass it over to George and Josh to discuss some of the upside.
Thanks, Mark. As you may have seen in the pre-feasibility news release yesterday, there's significant opportunity on the project to add material, increase recoveries, and continue with the theme here, which is a lot of flexibility and optionality, which makes this project get even better. One of the biggest opportunities for us, and something that we've talked about, is the Albion process. The Albion process is a Glencore technology. It's used at around 6 mines around the world on both gold as well as base metals. It uses atmospheric pressure in lieu of pressure oxidation to allow material to be processed and recoveries to be enhanced. This process in particular is quite appealing for the Sullivan Gulch area, which, as you may recall from recent drilling, has very long widths, typically 100 to 200 meters of 1.5 to 2 grams per ton gold equivalent. As you can see on the screen, though some of the material from Sullivan Gulch, the blue there being the sulfide and the red being the oxide and mixed, you can see that there's a large portion of this non-oxide material that's not in the pre-feasibility study and has the potential to come into future mine plans based on further test work with Albion. The initial test work that we have done with them, which was completed at SGS Labs under the supervision of Glencore, is quite good, and we look forward to further testing in this area with the anticipation of bringing more material into future mine plans. We just started drilling at Sullivan Gulch this week, and that is a mix of continuing to test this target, which the IP anomalies show extends to the southeast, as well as to get more material for Albion test work. The second major upside and option for us is Florida Mountain high grade. As many of you know that have followed the story, we've drilled pretty heavily into the area below the existing resource envelope at Florida Mountain. In fact, we have over 100 intersects of 4 grams per ton or greater, 4 grams per ton gold equivalent or greater over a minimum width of 1.52 meters. The history here is quite rich. It was mined up until the early 1900s, often at 1 ounce per ton material with a 0.5 ounce per ton cutoff. We've had a lot of success drilling below Florida Mountain, and early test work does suggest that this material could be processed through the same mill that's being presented here in the pre-feas. So providing a high grade component to the project as we move forward. We'll continue to test this throughout the year. There's also the opportunity here for an underground exploration program if warranted. So that concludes the prepared remarks from the company today. We do have a fair bit of questions that have come in over the Q&A feature. If you'd like to ask a question, please do use that feature. You just click on Q&A on your Zoom webinar panel, and you can type in questions. We'll get to them as best we can. In addition, we'll start there. And in addition, if there's time, please use the function to raise your hand, and we can try to pick a few more questions. So I think the first question to start, which would be helpful, is we had talked earlier about a 10,000 ton per day mill versus what we've presented in the pre-feas, which is a 6,000 ton per day. And I was just going to ask Mike or Tim if they could chat a little bit further about the optimization process that brought us to that 6,000 ton per day mill.
Sure, Josh, I'll take a stab at that first. Tim, if you'd like.
Sure.
So during the course of the pre-feasibility study, many trade-offs were completed, and throughput was certainly one of the things that we looked at. And we did model a 10,000 ton per day scenario, and that looked very economic and was attracted to us. And we did pursue that for some time. However, due to the current state of the market and the inflationary time, the CapEx for that scenario was going to be pretty unattractive. So for this study, we decided it was best to dial that back to 6,000, which was still very economic and very robust production profile for us, but a little less capital intense.
Thanks, Mike. In that same category, one of the questions was, why didn't we bring Albion into this study?
Sure, and that's a great question. Our very initial high-level scoping look at Albion didn't appear that we were going to be able to bear the burden. As we dug in a little deeper, as we moved through those trade-off studies, it showed more and more promise to us. However, we were not anywhere near having the necessary test work and engineering associated with that to get to a pre-feas level at this time. But that work is ongoing. We did some drilling last year to generate necessary materials for that test work out of Sullivan Gulch. And that material is at SGS in Lakefield, and the program is just kicking off to take the next level look at that. We did complete a Class 5 scoping level study with them last year. Was kind of our second look at Albion, and that looked very attractive. So that's what has driven us to continue down that path to do further testing and engineering. And we hope to have more exciting news on that in the near future.
Perfect. And keeping a bit with that mill, Andre, Tim, and Mike, I'll let you handle this, but where in particular were we seeing pressures from inflation in the construction of the mill and generally the construction of the project itself?
Well, keep in mind there was a much larger project. We've got a 35,000 ton a day heap leach and a 6,000 ton a day mill compared to 2,000 in the previous. We're seeing inflation in all of the construction costs, all of the materials. The labor costs now, all of these things are looking anywhere between 20 to 30, and in some cases 50% higher than what they were, let's say, 2 years ago. This is an inflationary time. We're hoping that there will be some resolution to that as we go forward, but a lot of the construction costs and certainly materials, cyanide, reagents, things like that have all increased rather significantly over this last, let's say, year.
Yeah, and I think the exciting thing about that is, even given this current environment, we're still looking very strong.
Absolutely. Sticking with processing, just because there's a few questions on that, on the project level processing. Another question is, where did you see an increase in stripping? Was it mostly related to the additional Delamar sulfides, or was it elsewhere?
It absolutely was the Delamar sulfides. By being able to bring in those Delamar ounces, which is a significant portion of this silver increase that we've got in this PFS. The Delamar pit, it does have a higher strip ratio than the Delamar sulfide pit has a much higher strip ratio than the rest of the Delamar and certainly Florida Mountain. So yes, that's a great question, and that is exactly where we saw those increased strip ratios.
Perfect. And one question which I can answer too, which is we've talked a lot about silver here as being a bigger component of the overall economics, and in the PEA, silver was about 18% of total revenue, whereas in the mill heap leach stages, you see that silver is 35%. So a significant increase in silver driven by recoveries by that mill and the inclusion of Delamar non-oxide. So I guess quickly turning to, and one more question, which we may need to check, Michael, but in the PEA, was the contingency also 20% on processing and heap leach?
In the PEA, we had 20% on almost the same areas. Certainly all of the civil type constructions, the heap leach pad, and the tailings facilities was north of 20. Some of the Some of the contingencies for things that are more standard, like mining equipment, were lower. But I would say that overall, the PEA contingencies were similar to the PFS contingencies.
Perfect. A few more on processing, Tim and Mike. So is Albion favorable on Sullivan Gulch, and could you discuss any preliminary recovery rates and potential costs, CapEx increases or savings that would be projected by including that circuit?
Yeah, certainly. I'm not able to spitball that CapEx off the cuff, but we could pull that up. As I said, we completed a class 5 level scoping study with Glencore and SGS previously. What we see is overall recoveries from that very preliminary scoping level study. We had overall recoveries of 80% or better in Sullivan Gulch. You know, it doesn't impact the flotation recovery, which is already quite good, but it has a dramatic effect on the leach recoveries of the concentrates. Glen Silver also saw a dramatic improvement that was up into the range of the 70s, and one could expect we can improve on those. Those composites were not optimized in the flotation program at that time, so we're looking for a lot of potential benefits to come. And again, I apologize, I can't speak to the CapEx off the top of my head here.
And in that same regard, will the Delamar sulfides impact the higher recoveries of the Florida Mountain sulfide when blended together at the mill?
Yeah, I think that's reasonable to expect. Now, the Florida Mountain sulfides, you know, have a much less refractory nature to them, so we do see very good recoveries there. But I would absolutely expect it to further enhance those sulfide recoveries for sure.
And is Albion something you pay a license fee for?
You know, I can't answer that, Josh.
Okay, we can get back to you on that one. I'm just going to hand it over to George to kind of talk a bit about next steps for the company, a bit on maybe the market perception of the pre-fees, and probably wrap it up. If there's any more questions, feel free to put them into the Q&A feature. We can always follow up directly with you. And I would note that in the press release, there is a sensitivity table. So if you would like to see NPV and IRR at higher gold and silver prices, you can definitely reference it there. But over to you, George.
Yeah, thanks, Josh. With respect to this morning's market reaction, I think this sort of the vast majority of questions that we've had from the investing public have revolved around, quote, help me out with making an apples to apples comparison from the PEA to the PFS. And the short answer is these are two different projects. The scope of the PEA is far different from the scope of the PFS, which explains, you know, some of the increased capital from PEA to PFS. You know, for example, the PEA looked at 27,000 tons per day of heap leaching. This PFS looks at 35,000 tons per day of heap leaching. The PEA looked at 2,000 tons per day of sulfide milling. The PFS looked at 6,000 tons per day, so a 3x on the mill and 30% on the heap leach. So that explains some of the capital increases here. You know, another series of elements that crept into the study, there is no question we're in an inflationary environment, and some of the capital items and some of the OpEx inputs, specifically with respect to consumables, were much higher as compared to the PEA. There's no question about that. And the entire mining world is in fact seeing that sort of escalation, not only in CapEx, but OpEx as well. So we weren't surprised by any of these elements. But despite the encroachment of inflation into this study, we still managed to produce, you know, a massively economic study with a lot of optionality. And that's maybe another piece that kind of might have gotten lost on people is, you know, we've built this project or this PFS for the times that we're in, which is, largely speaking, inflationary, and who knows when that's going to end, if it will ever end. But the beauty of this project really is, we can start with the heap leach, which is massively economic, use the cash flow to finance the mill construction, or if we're in an even more inflationary environment in the future, choose to defer that mill expansion for a later date. That's the kind of optionality that's really critical to a mining project. Certainly, it's a lesson I've learned over the years in working at operating mines. Having various avenues to pursue is always important. So I think those elements kind of got lost on the investing public this morning, and we'll just have to keep hammering those home. With respect to next steps, obviously, the PFS really is the kickoff to the permitting to come. And I often get the question, why are you guys doing this PFS study? Why don't you just sit back and just drill for the next 2-3 years, increase the resource? Well, that would be great. Some issuers choose to do that. We choose a more balanced approach, which is get studies done, de-risk the project, get it through permitting, and get it ready to stick a shovel in the ground to build. There's a time value of money aspect here, which I think gets lost on a lot of people. We had to do a PFS study in order to kick off the plan of operations, which will then ultimately lead to greenlighting this project for construction. And the PFS was a critical part of that. Not to say that we're going to stop exploring. Exploration has always been the hallmark of everything that we do as a group in Integra. We have no plans to fall off the cliff of the valley of the Lassonde curve, because we're going to keep expanding resources on the project. That's clear. There are some tremendous opportunities out there to expand resources upon. Josh touched on a couple of them. I think you'll see a focus on Florida Mountain as well from an exploration perspective, and so stay tuned for that. And then really the big news on the permitting front is we're going to commence all the work that we need to do to submit the plan of operations next year, which is a big part of our permitting. And that's kind of what's in store for our shareholders this year. Lots of exploration to come, lots of focus on high grade, lots of further commentary on things like Albion, which can only enhance an already great project from an economic perspective. And that's it.
Perfect. Well, thank you, George. Thank you, everyone, for joining in today. I really appreciate the interest in the story. As I mentioned, we did record this webinar, so it will be available on our website later this week after it's been processed. If you have any additional questions, please feel free to reach out. You can email us at ir@integraresources.com. Additionally, if there's any questions which we didn't answer, we can reach out directly to you this week and discuss further. But thank you so much for taking the time to join us today. We look forward to the year ahead and look forward to talking with you all soon. Thank you.
Thanks, everyone.